Let's talk about Constellation Brands, the company behind huge names like Corona and Modelo. Their latest financial report just dropped, and honestly, it's a wild ride. It feels like we're reading about two completely different companies at the same time. So let's dig in and figure out what is really going on.
Right, you see these bottles everywhere. They are absolute giants in the beverage world. But their latest earnings report, it was a total head-scratcher, with numbers that just seem to be all over the place. We're going to peel back the layers here and see what's actually powering this company.
All right, so let's start with the big, flashy headline numbers. This is where you can immediately see how the company seems to be telling two different stories at once.
At first glance, you'd think they hit it out of the park. I mean, look at this. Reported operating income shot up an incredible 171% compared to this time last year. Just a massive number.
But here's the twist. How on earth does your profit jump that high when your total sales actually fell by 15%? It just doesn't add up, does it? Well, the answer, my friends, lies in the wonderful weird world of accounting.
The secret ingredient here is something called a goodwill impairment. Now, it's a super fancy term, but just think of it like this. Last year, the company had to take a huge $2.25 billion paper loss. They basically had to admit that a part of their business wasn't worth what they thought it was. So that one-time hit made last year's profit look awful, which in turn makes this year's profit look artificially amazing.
So when you strip out those one-time accounting quirks and you look at what they call comparable operating income, you finally get the real story. The actual underlying business performance, it was down 13%. Now that number makes a whole lot more sense when you remember that sales were down.
Okay, so to really get what's going on with Constellation, you've got to understand that it's basically two different companies mashed into one. First up, let's talk about the absolute powerhouse of the company, the beer business.
The beer division, with icons like Modelo and Corona, is the engine that drives this entire company. It brings in the lion's share of the money, so how it performs is absolutely critical to everything else.
And this is where it gets really interesting. We have to look at something called depletions. Again, another industry term, but it just means how much beer the distributors are selling to stores and bars. It's a pretty good way to measure what people are actually buying. And what we see is a split. Some of their other brands like Pacifico and Victoria are on fire, growing like crazy. But the two biggest flagships, Modelo and Corona, actually saw declines.
And this really shows you that split personality in action. You've got these high-energy challenger brands gaining a ton of ground, while the established icons, the ones you see everywhere, are feeling a little bit of pressure. It's a tricky balancing act for the company. You have to fuel that new growth without letting your main business slip.
So when you roll it all up, the entire beer segment saw its net sales drop by about 7% this quarter. And that's a pretty big dip for the part of the company that's supposed to be the main growth engine.
But, and this is some really important context, the company is quick to point out this drop wasn't because people suddenly stopped drinking their beer. It was mainly because their distributors, the middlemen, decided to carry less inventory this quarter. So the thinking is, it's more of a short-term supply chain thing than a real collapse in demand from you and me.
Okay, let's switch gears. We're going from the company's steady, powerful engine to, well, its very risky experiment, the wine and spirits division. And if you thought the beer numbers were interesting, whoa, this division is going through a massive, dramatic transformation.
And I'm not kidding when I say massive. We are not talking about small tweaks here. This is a story of a deliberate, strategic, top-to-bottom overhaul. They're trying to completely reshape what this part of the business even is. And the scale of this change is just staggering. I mean, look at this. Net sales for wine and spirits plummeted by 65%. 65! If you didn't know the backstory, you'd look at that number and think it was a complete and utter catastrophe. But here's the key to the whole thing. A huge chunk of that drop, $221 million of it to be exact, was completely intentional. It happened because the company decided to sell off a whole bunch of its brands. This wasn't an accident, it was part of the plan. The technical term for this is divestiture, but really you can just think of it as a strategic garage sale. The company got rid of a lot of its lower-priced, mainstream wine brands so it could focus all its time and money on the fancier, more profitable, premium stuff. It's a huge bet on quality over quantity. So, with all of this change and transformation happening, where is the company's cash actually going? Let's follow the money and see what their priorities are. And it really comes down to two big things. First, give cash back to the people who own the company, the shareholders. And second, reinvest some of that cash back into the business to make it stronger for the future.
It's that classic balancing act. Reward investors today while building for tomorrow.
On the rewarding investors front, they spent almost $300 million just this quarter buying back their own stock. That reduces the number of shares out there, which makes every share that's left just a little bit more valuable.
And on top of that, they paid a direct cash dividend of $1.02 for every single share. That's just a straight-up cash return for investors who are sticking around through all this change.
And then for the future, they invested $217 million in capital expenditures. That's the money they're spending to upgrade their breweries, improve their operations, and basically make sure the business is healthy and growing for the long haul.
So that's the story of this very complicated quarter. Now, what about the future? What is the company telling everyone to expect for the rest of the year?
Well, their official forecast shows they expect some of these headwinds to stick around. They're guiding for beer sales to be down a little bit for the full year and for that new, slimmed-down wine and spirits business to see a pretty big drop as it finds its footing. But, and this is the big but, they still expect to deliver really strong comparable earnings per share when all is said and done.
And so that leaves us with the big multi-billion-dollar question. With its main beer engine sputtering just a little bit, and its wine business in the middle of this massive, risky renovation, has Constellation Brands made the right bet? Is this painful, strategic slim down the right move to build a more profitable, more premium future? Well, only time will tell.